Welcome to Investment Island, folks, a place where we explore the highs and lows of financial history. Today, we're diving into one of the most significant events in financial history, the stock market crash of 1929. This event reshaped the economic landscape of the entire world. Buckle up, because this is a wild ride. The journey through the Roaring Twenties is filled with ups and downs, much like a roller coaster. The 1920s in America were a time of unprecedented economic growth and social change. Cities were expanding and new technologies were transforming everyday life. The Roaring Twenties, as they were called, were a period of jazz music, flapper dresses, and a booming stock market. It was an era of cultural dynamism and financial exuberance. People were optimistic, and the American dream seemed within reach for everyone. The future looked bright and prosperity seemed endless. But beneath this veneer of prosperity lurked a dangerous cocktail of economic factors that would ultimately lead to disaster. Overspeculation, easy credit, and a lack of regulation were ticking time bombs. Like a house of cards built on a shaky foundation, the booming economy was about to come crashing down. The illusion of endless growth was shattered, leading to one of the darkest periods in financial history. The economic boom of the 1920s was fueled by several factors. New technologies like the automobile and the radio created new industries and jobs. Mass production techniques made goods more affordable, leading to increased consumer spending. The stock market soared, creating a sense of wealth and prosperity. However, this prosperity was not evenly distributed. Farmers, for example, struggled with low crop prices and mounting debt. Income inequality widened, with the richest Americans capturing a larger share of the nation's wealth. The rapid expansion of credit also masked underlying economic problems. People were borrowing heavily to buy stocks and consumer goods, creating a bubble that was bound to burst. The stage was set for a dramatic fall. One of the key factors that contributed to the 1929 crash was rampant speculation in the stock market. Investors, blinded by optimism and the allure of quick riches, poured their money into stocks, driving prices to unsustainable levels. The stock market became a giant casino, with investors more concerned with short-term gains than the underlying value of the companies they were investing in. Stock prices were increasingly detached from economic reality, fueled by speculation and hype. This speculative frenzy created a dangerous bubble in the market. Like a balloon inflated beyond its capacity, it was only a matter of time before it popped. Adding fuel to the fire of speculation was the practice of buying on margin. This allowed investors to purchase stocks with borrowed money, typically a small percentage of the total purchase price. While this amplified potential gains, it also magnified potential losses. Investors, enticed by the prospect of outsized returns, took on increasingly risky positions in the market. They were essentially gambling with borrowed money, betting that stock prices would continue to rise indefinitely. This widespread use of margin buying created a highly leveraged and unstable market. When the market eventually turned south, as it inevitably would, these leveraged positions would act as accelerant, fueling the downward spiral. Section 5. The absence of guardrails, a market unrestrained. Another contributing factor to the crash was the lack of regulation and oversight in the financial markets. The government took a laissez-faire approach to the economy, believing that the market would regulate itself. This lack of regulation allowed for rampant speculation, insider trading, and other risky practices to flourish. There were no safeguards in place to prevent or mitigate the effects of a market downturn. The absence of effective regulation created an environment ripe for disaster. It was like a car without brakes, speeding towards a cliff edge with no way to stop. Section 6. Black Tuesday, the day the music stopped. The stock market reached its peak in early September of 1929, a time when optimism was high and the economy seemed unstoppable. Then, on October 24, 1929, panic selling began. Investors started to realize that the market was overvalued. The Dow Jones Industrial Average plunged by 11%, marking the beginning of the end. The initial shock was just a precursor to the devastation that would follow. On October 29th, now known as Black Tuesday, the market crashed in earnest. The frenzy of selling reached a fever pitch. Over 16 million shares were traded, and the Dow Jones Industrial Average fell by another 12%. The sheer volume of trades was unprecedented. Investors, gripped by fear and panic, rushed to sell their holdings. But there were few buyers to be found. The market was in free fall. The crash sent shockwaves throughout the global economy. Countries around the world felt the impact as markets tumbled. Banks failed, businesses collapsed, and millions of Americans lost their jobs and savings. The financial system was in disarray. The Roaring Twenties had come to a screeching halt. The era of prosperity and excess was replaced by one of hardship and uncertainty. Section 7. The Great Depression, a crash's long shadow. The stock market crash of 1929 ushered in the Great Depression, the worst economic downturn in modern history. Unemployment soared to 25% and industrial production plummeted. Breadlines became a common sight in cities across America. The Depression had a profound impact on American society. It shattered the illusion of prosperity and shook people's faith in capitalism. It also led to widespread social unrest and political instability. The legacy of the crash and the Depression would shape government policy and economic thinking for decades to come. It highlighted the importance of regulation, the dangers of speculation, and the need for a social safety net. Section 8. Lessons learned. The importance of regulation and risk management. The stock market crash of 1929 serves as a stark reminder of the importance of regulation, risk management, and financial literacy. This catastrophic event, often referred to as Black Tuesday, marked the beginning of the Great Depression, a period of severe economic downturn that affected millions of lives. It teaches us that unfettered speculation and excessive leverage can have devastating consequences. The rampant speculation of the 1920s, fueled by easy credit and a lack of oversight, created a financial bubble that eventually burst, leading to widespread panic and financial ruin. The crash also highlights the importance of understanding economic history and learning from past mistakes. By examining the factors that led to such a monumental collapse, we can better prepare for and potentially prevent similar crises in the future. By studying the events that led to the crash, we can gain valuable insights into the workings of financial markets and the importance of sound economic policy. This knowledge is crucial for developing strategies that promote stability and growth while mitigating risks. The lessons learned from the 1929 crash continue to shape financial regulations and investment practices today. Regulatory bodies have since implemented measures to increase transparency, reduce excessive risk-taking, and protect investors. It is a reminder that while markets can be powerful engines of growth, they also require careful stewardship and oversight. Effective regulation and risk management are essential to ensuring that financial markets operate smoothly and sustainably, benefiting society as a whole. Section 9. Stay informed, stay invested, like, subscribe, and join the conversation. That's it for today's deep dive into the 1929 stock market crash. Remember, folks, knowledge is power. The more you understand about financial history, the better equipped you'll be to navigate the markets and make informed investment decisions. If you found this video insightful, don't forget to give it a thumbs up, subscribe to the channel, and hit that notification bell so you never miss an episode of Investment Island. And be sure to share your thoughts and questions in the comments below. Until next time, stay informed, stay invested, and stay bullish.